Hey. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today on today's live, we are going to be talking about whole life insurance and why you probably want whole life insurance even if you don't need it for the death benefit or want it for the death benefit. This is one of those topics that I think a lot of people are bringing up. I don't know why, but maybe it's the content I've been making lately. I keep getting a lot of, comments about people saying, what happens if I don't need it? I'm a unique individual. Maybe I don't want the life insurance. Maybe I don't need the life insurance, but I'm younger, I'm older. It doesn't really matter the age, but at the end of the day, does whole life insurance more specifically make sense for me? And a lot of people will say yes for different reasons. I'm going to say yes for a lot of reasons. I'm going to explain those reasons. And I guess the first reason that I want to get right into is the infinite banking concept reason. Now, hey, what's up, Multimeter? What's happening, man? So here's what I want to say to this point. And it's interesting because I had a really good conversation with somebody earlier who was asking questions about infinite banking. I was actually an agent, somebody who's on my team, who was asking questions about the fit of an infinite banking policy and how to use the policy loans, when the policy loans make sense, running expenses through your personal finances through your policy. Does that make sense? Does it not make sense? And at the end of the day, I'm not what I would call an infinite banking purist. I believe in a lot of the concepts and the philosophies and the foundations of infinite banking, and I think most of it is right on the money. But I also think that the idea of eliminating the bank from your life is kind of not the most efficient way to go. And what I mean by that is sometimes we have the ability to use a bank and to take advantage of their cheaper money. But the beautiful part about having a banking policy is the fact that you have the money there and you have the control, and it provides options for you. So whether you utilize your policy for all the policy loan provisions or whether you utilize a third-party bank really will depend on the cost of money. Now, I will argue very, very strongly that out of the gate, utilizing a whole life insurance policy for everything is not wise. It is very circumstantial. It's going to be dependent on what the current environment looks like. So let's use an example. I'll use a very specific example. Let's talk about buying cars. Now, I could go out and buy a car. Not all things are equal, right? So actually what I want to do here is I'll go here. I'm going to use an example to buy a car, just as kind of a, just an example on what this can look like. So one of the things to say, so should I buy a car using whole life? So the question is, let's just say you want to buy a $50,000 car. And let's say you got $100,000 in your policy. So, having the cash to buy the car, flowing it through your policy could work. But now a lot of people are going to say, all right, what happens if I could get 1.9% fixed rate from a bank or from like the car dealer, from like GM Financial, let's just say, something like that, because it's going to be a finance company like that will do it. And then a lot of times people are going to say, well, I could get 5% through my policy loan. So there's a lot of people that will say that having a $50,000 car and paying the 5%, which is an unstructured 5%. So a lot of people will say, well, having unstructured at 5% is way better than having structured at 1.9% because of the flexibility that it provides. I would argue that you could take the 1.9% right here on a fixed rate and have the policy to back it up. So get the 1.9% $50,000 loan and make the payment at that cheaper money. And then if some month you can't make the payment of $650, $700, whatever that payment would be, if you can't make that payment of $700, take a policy loan at that point in time and pay that payment from there, and that will reduce your long-term actual cost of money. But that's not an apples to apples comparison, because when we look at the $50,000 car, that is a sticker price. If you've ever gone car shopping, you know that you're probably not going to pay whatever they're asking for this. And the challenge is 1.9% fixed rate is not, what it is a promotional rate. And it's not necessarily actually apples to apples on how this all works, right? It's not apples to apples on what you're actually paying for the car. Because what happens is, and this is where I love having money in a policy. Now, I'm not necessarily a big fan of running all the money through our policy, but by having the 100K cash value here in the policy to be able to get this $50,000 car, now we're able to show up to the dealership with a completely different level of power and authority to be able to negotiate for this car. Because what's going to happen now, if we know that we could take this 5% policy loan, now our job as being a good banker, as being a good consumer, is to figure out, based on this $50,000 that we are going to buy the car, if we utilize this 1.9%, because that's our option, because of the fact that we have access to this capital in this 100K that we're going to utilize, and we know it's going to be about 5% in this example. Question is, if I went into this dealership, what could I negotiate this car down to for that? Now, I want to use I have a really good personal example that I use for this. I had to go buy a trailer. The trailer, it was a camping trailer. Sticker price was $29,995. They offered to give it to me for $26,995 at a rate of 4.9%. Okay, so all things equal, that looked pretty good for a trailer. But here's the deal: when I was able to go in and say, "Hey, I have cash," they don't need to know that I'm taking a policy loan and that I'm financing it on my own. I just went in and said I had cash, and cash is king to those people. I was able to get it for $19,990. So it's not a matter of the rate that I'm paying. It's about the purchasing power and the buying power and the cash. I was able to get effectively a 33% discount on this, compared to the MSRP. I don't know what the discount is off that, but it's like 30 something percent, maybe 30, maybe 28% or so of a discount off of that price that they were going to give me. Am I going to pay a little bit higher of a rate annually as far as an interest rate? Yeah, absolutely, I am. And I don't have a problem with that, because I'm saving all this money off of the sticker price. And at the end of the day, you could do this with a car too. So like maybe this 50,000 at 1.9, maybe we negotiate this down to 44,000. Now, I talk about my Jeep all the time. It has to go when you're going in, and if I'm paying 44,000 on this and I'm paying 5%, I'll take 44,000 at 5%, knowing that I have the flexibility, versus 50,000 at 1.9%. That's going to work out. And so here's the deal: I did this with my Jeep. The sticker price on my Jeep, I had no problem making this public. Sticker price was 48,000. It was a 2017, or it was a 2018, but it was when the model was coming out for the new JL. If anybody understands Jeep, I'm going to nerd out a little bit on Jeeps here. JK went to JL in 2018. 2018 was the last year that JKs were made, but it was the first year the JL model was made. And so they had a bunch of these JKs sitting on the lot. The sticker price was 48,000. I was able to come in, negotiate, do all this stuff, and instead of paying 48,000, I was able to pay 34,500 for this Jeep. Right? Think about this. I don't know what percentage discount that is, but because of the capital, because I came in with cash and they were just looking to move these cars off the lot. That's why we don't make emotional decisions around these processes. Yes, obviously my Jeep, I've had this conversation on this channel a lot. Obviously there's emotional conversations to be had anytime we make any kind of purchase of that nature. But at the end of the day, being able to leverage this cash value and have that financial system to make me a better consumer, make me a better negotiator, and find the better deal, that's worth its weight in gold, right? So I think that's important to understand. So now, as we go through that, now what I want to do is I'm going to go back here, and so that's kind of like the banking side. I guess I'll start with there. Is if you don't want to have the whole life insurance for the life insurance component of the policy itself, well, the first thing is so you can be your own banker. You can function as your own banker. And you, what I just did there in that example with the cars, like I said, I'm not a big believer of flowing all the money through the policy as a principle, as a foundation of saying this is the rule, I have to use all my money in my policy. But I am a believer of utilizing the money in the policy to create leverage, to create opportunity, to create negotiation, to find the cheapest money, to get the cheapest assets, and to make to be the best consumer that I could possibly be. I'm not saying go out and buy the Jeep for the sake of buying the Jeep and financing it and making money in your own policy, because it doesn't work that way. But how it does work is if I'm going to buy that Jeep anyway, I want to buy it and leverage it and finance it in the most effective way possible. Because remember, when I'm borrowing money against my policy, inside of the policy, I could borrow at 5% hypothetically and earn at 5%. Let's just say if that's how it was working, apples to apples, then it becomes kind of a wash, even though it's not that clean. And I have plenty of videos talking about that. I'm not getting into that in this video. But if I could but when I take a loan against that policy, I'm getting a loan. It's an independent loan from the insurance company. It does, if I'm using a non-direct recognition company, it does not impact the growth of the policy. So for the sake of argument in this conversation, I'm just doing a loan for 5%. The policy value is growing the same way. So if I could get a loan at cheaper than 5%, I should go get a loan cheaper than 5%. Whereas I think pure infinite banking says don't go get a loan outside of the policy. Their whole idea is like, why bring the bank back into the conversation when you can, finance it through your policy? The whole point is to become your own banker and avoid the bank. I would say that that's just inefficient. If you have the ability to leverage the policy and eliminate the need for the bank, I think that puts you in control. That's what this is really about, in my opinion, is eliminating the need for the bank and putting yourself in a position of power so you can actually control the bank. Maintain the banking function in your life, absolutely, but that also means you can bring almost like banking partners into the equation by utilizing your own banking policy to be able to do so. And now that just creates more leverage and more control so you can make better decisions. And to me, that's the first place to start. Now, the second reason, and I guess is actually the first, I started with that because I think it's the biggest topic. I think it's the place that the most people have the most interest in, and it seems to be a big conversation online these days. But I'd be curious to know if anybody is utilizing a policy that way. If anybody has any more questions about that, circle back, make a comment in the comment section below. In the live chat stream here, I'll do my best to circle back to it. I'm checking these comments. I want to engage any questions that you have. I'm happy to do so. That's the goal of these lives. That's the reason I'm doing these things live rather than just recording this topic, because hoping as you're watching, if you have any questions, comments, I can engage with you and we can go from there. Now, the next reason I think you want a whole life insurance policy, even if you don't need the life insurance, is you just need an emergency fund. I always start here when I talk to people, when people are saying, "Hey, Chris, should I get a policy?" It's like, whether you have a need for the life insurance or not, I'm a big believer that your whole life insurance policy is the most effective and efficient place to store capital that you're going to have, when you look at all the benefits of it. And so from that perspective, I look at it and I say, well, if you believe you should have an emergency fund, my question to you is, how much do you think you should have inside of that emergency fund? Hey Ray, what's happening, man? When you decide how much money you need in the emergency fund or how much you want to save every month, I would say that's your number that you want to try to target. That's your first kind of target goal as far as how much cash value should you have in a policy. You should kind of figure out, when do you want to have that amount of money in your policy? Let's just say you make $50,000 a year and you say, hey, I believe I need 6 months of income in an emergency fund. So, okay, you need $25,000 in cash value. So you got to figure out, okay, my number's 25,000, and then you got to have a target date of when you want to have that money available by, and then you got to reverse engineer the policy to be able to meet that goal, right? And now I'm a big believer we should have 2 years of income in safe, liquid, accessible capital inside of our policies, because the number 3 reason that I put on here is an opportunity fund. I talk about this a lot in my Life 180 pyramid talk, and hey, what's up, Dave? I'm a big believer that we need to have 2 years of savings, liquid accessible capital inside of our whole life policy, or inside of any kind of capital. Once again, whole life is just the most efficient place to save it. But I believe we need access to it because of emergency and opportunity. I think it's interesting that people like Dave Ramsey will say you need 6 months of an emergency fund. He's been saying that since the 80s. And if you look at the Department of Labor Statistics, Bureau of Labor Statistics, they say that it takes about 1 month for every $10,000 of earned income. So that rule, 1 month of every $10,000 of earned income to find a job if you get laid off. So, when you look at it from that perspective, the answer of how much money you need in an emergency fund in ratio to your income really changes. Like if you have a lower income job, well, then it's easier to find a job replacement. If you have a higher income job, you actually need more emergency reserves because it could potentially be harder for you to find a job. It could take longer for you. So you're going to need a bigger reserve runway to be able to make that gap work. Hopefully that makes sense. And then at the same time, I believe the market is cyclical. It's not linear. It's going to go up. It's going to go down. And when times get rough, if you lose your job, you want to be able to have that emergency fund that year. I think that's the safe number, in my opinion. You want that year for emergency, and then you also want a year for opportunity, because when times are tough is when the opportunities are highest, and you want to be able to come at this from an abundant perspective. You always want to be able to come from the mindset of being able to open up opportunity and find opportunity. And Nelson Nash always says in his book, and it's one of my favorite concepts of this, utilizing infinite banking, utilizing whole life insurance as an asset, is the fact that when you have these policies capitalized, opportunity has a way of tracking you down. And I could speak to that very, very personally and specifically. But anyway, I got a question here. Let me, do you help set policies with whole life insurance? Yeah, Miguel, we help people with that all the time. If you are interested in setting up a call, we do a thing called a clarity call. And the reason we call it a clarity call is because our whole focus is helping you understand what you're getting involved with. This works differently in everybody's life, depending on your income, your assets, your debt, what your goals are, what your time frames are. It works differently for different, it's different for everybody. So the goal of the clarity call is to help you have complete clarity about how this can work in your life, and then we can design a policy so you can see it to fit your specific goals and objectives. I don't believe this is a cookie cutter situation. I don't believe this product should ever be looked at in a cookie cutter format. I think it's a very personal decision. I think it's a very personal about how you execute with it, right? So that's how you go. Hey, Dave, thanks, man. Appreciate it. I believe, right? Yeah, Chris does. I believe. Yeah. We help people set it up all the time. I help personally. I have a team of agents. I think we're nearing 200 agents across the country now with Life 180. We have our IMO. If you are an agent and you're looking to learn, I do my best to provide what I believe is like the best training in the market on the YouTube channel here. For Index Universal Life, for Whole Life, for personal finance, utilizing life insurance as an asset, videos like we're doing now. But we also have a private agent community platform for the agents that are on our team that is a much more elaborate, in-depth level of training that I cannot share publicly because of compliance reasons and all that stuff. We're able to share things that we just can't share on public ways, stuff that is agent-only focused. That I think is really, really good stuff. So going back to what I was talking about, sorry for the tangent, but I was answering questions here. Hopefully that makes sense. If you have any more questions on that, let me know. I'll re-click in. But so we talked about the savings, the emergency fund, and the opportunity fund. Now, once again, I'm just a huge believer, just to kind of wrap this up with a bow. I'm a huge believer that if you believe you need an emergency fund and you believe you should have an opportunity fund, well then I'm going to tell you that whole life insurance is for you, because there's no better long-term saving vehicle than a whole life insurance policy from a liquidity perspective, from a return perspective. I always tell people that the only objective life insurance companies have is to manage your purchasing power and to protect the purchasing power of your money and get you the best return possible with the least amount of risk. Tom Wall, who I interviewed on this channel, he wrote an amazing book called The Permission to Spend, talks about it all the time. And he basically says whole life insurance is the best borrowing that money can buy because of all the value that it brings to the table. And that's kind of what I'm talking about now. So if you're ready to learn more, I pinned a message to the top, and you can check out the calendly.com/_life180 /clarity call. I just pinned the message to the top. You can go to the top and look at the link at the top of the messages here. Or in the description below, there's a little link that says to click on it for a clarity call. If you're interested in doing that and having a conversation about how to implement life insurance in your life, I would say click on that link. It'll bring you to an event calendar. You can pick a best time that works for you, and we can get on a call. It's that simple. And so anyway, that Tom Wall says it's the best borrowing money can buy, and that's what we're going over right now. And so now, the focus of this video, just to kind of reiterate for people joining out, is the fact that whole life insurance is an amazing asset. Now, the challenge is a lot of people don't have a desire for the actual death benefit of the life insurance. So the question is, at that point in time, if you have no interest in the death benefit, do you still want to have whole life insurance because of all the other benefits, i.e. the living benefits? Because, and this is actually spurred by a comment that I got from a guy this morning who was like, hey, I'm 27 years old. What if I'm not interested in having a family and I'm not going to really need the life insurance? And even if I do, I don't really want to leave them better off. I'm just more concerned about me improving the quality of my life. Well, here's where it gets really powerful. I'm a big believer in the fact that, okay, yeah, we have our emergency fund, we have our opportunity fund. I call it cash flow hacking. I wrote a book called Cashflow Hacking. It's all about utilizing life insurance, whole life insurance, properly designed, borrowing against it, leveraging it for cash flowing assets, using the cash flow to manage the policy loans, capitalizing and creating this cycle of opportunity and the growth in the cash flow and the growth in the policy, the growth in the death benefit, all these different things that it can bring together. And that's what I call cash flow hacking. And it's all about utilizing whole life insurance as a foundational asset in your life to be able to go out and increase your investments in cash flow producing assets, which I think is way more effective, way more important for you to be able to reach financial independence faster than saving and accumulating and thinking you're going to be able to retire at 65 with any level of financial freedom. All right. So Andrew Lee has a question on, do I have a question or do I have any thoughts on using whole life as saving for children's college fund? Yeah. So interestingly enough, I have a video on this topic. It's actually, so I used to do a lot of stuff for college planning when I was with my former company. That was kind of one of the roles that I played and did a lot of work with. And here's the deal. Whole life insurance is one of the most powerful assets when it comes to college planning, because here let's do this. I'm gonna go here. Let's scroll to the side. I'm producing my own show here today, guys. I don't have any help, so I'm just punching buttons around here. Hopefully I don't screw anything up. So let's talk about college funding. How old is a kid? Let's talk about it. Whoever asked that question, give me some stats. How old is a kid? Let's role play. Let's talk this out a little bit. We'll talk about college funding for a kid. This is another, once again, it's a little off topic because of whatever, but maybe you want to do this for a grandkid. Maybe you want to do it for your own kid. But here's the deal. I'm gonna say a 5-year-old. Okay, 5-year-old child. And the question is college funding. So what are the options for college funding? You got a 529 plan or you have a whole life, right? Those are the two options. So we could save, let's say with either one of these situations, we could save, let's say we're saving, I don't know, $2,500 per year, right? And we're gonna save $2,500 per year here. So here's the problem. Okay, 4, 5, 7. So I hit the nail on the head. Let's focus on the middle. We'll say a 5-year-old. So here's the deal. When we look at a 529, what is the benefit of that? So you get to tax defer the money, and it's tax-free distribution as long as you use it for college. But the problem with the 529 account is two things. It counts towards your expected family contribution, right? So which is a really negative thing, because if you save up enough money in this account, so let's say that 2,500 going to 18 times 10, 25,000, let's say it's like 30K plus gain. You've contributed 30K plus gain, and we'll talk about that more. But whatever that account value is at the end, you're gonna have that count towards your expected family contribution, and that's actually gonna increase your cost of college. My big belief for college planning is that there's a sticker price, and then there's actually the price that people pay. And if you pick the right college, if you pick the right school for your student, then that sticker price could go way down. But the more money you have in a 529 account, it's gonna be very financially based. If you have too much money in your 529 account, it's actually gonna make your bills and make the actual cost of college more expensive than it needs to be. And so that's really important. So volatility, market volatility is really important here, because think about it. When we're talking about investing, and I'm not a big believer in this philosophy in general, but one of the things to understand when we're talking about investing, and we're talking about just the future, and like, let's say I'm 30, let's say I take a 35-year-old and they're saying planning for retirement. Well, you're talking about a 30-year time horizon, right? And a 30-year time horizon, we're gonna have market ups and downs, and that's fine, because the market cycles are every 8 to 12 years, we got a down cycle, and then we have a bigger boom cycle. And in the long run, if you just buy and hold, it's gonna trend out and it's gonna be good for you, right? Like, that's the idea behind traditional financial accumulation planning, right? Okay, I don't agree with that personally, but it gets way worse when we start talking about 529s, because what are you doing? You're investing, you're putting money into risky accounts, and there's volatility in that account. When we're talking 5 to 18 years old, when we know we need to take a distribution, you don't have any other assets set up in a 529. So even in negative years, you got to start taking distributions from this. What happens if the market crashes the year before and you lose a percentage of your money, in this account right before that? Well, now you have to start negatively liquidating, negatively performing assets. Not only that, they're going to use this 529 as a way. You're going to have to use it as your expected family contribution is going to be higher, and you have to use this when you're 18. If you use a whole life policy here, by the way, not only is your EFC less, right, but you can take loans which you're not going to have to pay interest on, right, while they're going to school. So you can let your whole life policy compound till like age 22 or 24, depending on how long your kid takes to get through college, right? So the money's not, like, you don't have to deal with all that until the fact, this money's going to compound for longer. You're going to get an extra 4 or 5, 6 years of compounding, hopefully not 6 or 7, because obviously then your student's going to school way too long, and it is what it is. But you're dealing with the volatility, and this is going to be fixed and guaranteed. And we know beyond the shadow of a doubt, when we look at a whole life policy, we know worst case scenario what the cash value is going to be, right? Because we know the guarantees, we know the non-guaranteed are going to be very, very predictable. And anything that is predictable when it comes to personal finance, and we know we can plan for it, now we can execute accordingly. We don't have to deal with all these variables and uncertainties in the market. Uncertainty is like the worst thing when it comes to personal finance, and that is one of the challenges with 529 planning. And so I think between the fact that we're talking the expected family contribution, I think the fact that we're talking about, I think the fact we talk about the volatility, the expected family contribution, your actual ability to reduce the cost of college, I think it's powerful. And for me, here's the deal. I look at this, what if my kids don't want to go to college? Right? And this is the big one for me, because I'm not a big believer in college. Now, I went to college, my wife went to college. I don't think the value in college is what it used to be. I think, paying $60,000 a year to go to school and, get out, get a job, and get taught by people that have never really produced much for the most part in the actual world, to me, that's just not something I'm really down with. I'd rather, at the end of the day, I'd rather save up, 100K. Let's say all things being equal, I'd rather save 100K over here instead of 100K in a 529 account. Because this 100K here, if my kid decides to not go to college, now I can go get a mentorship. I could do outside programs. Like I do a lot with the world of ClickFunnels and marketing and stuff like that. And I'd rather go out and put money towards a mentorship with like Russell Brunson and have him join my daughter and kid son join an inner circle with some community, get into the real estate market, get mentored by people that actually have fruit on the tree and have produced big things in this world, right? To me, that's more valuable than a college education at this point in time. Now, if they want to be lawyers, if they want to be doctors or scientists or engineers, well then yeah, there's going to be an element that they got to go through and they're going to have to go to college. But once again, I want the flexibility on that, right? Like to me, that's a big thing. So follow-up question. Okay, so finance single family home with my whole life policy for $400K. Do I have to finance the entire purchase price of the property or just put the down payment? Follow-up question. When I borrow against my policy, I believe we utilize our death benefit. No. So, all right, that's a good question. So that is actually a fallacy that is, unfortunately, a lot of these, it's misinterpreted. They say, so let's just say, I'm going to go in here. Let's just say you have a whole life policy and you have the cash value, you have the death benefit, and you have premium. So what I like to do, my favorite way to do this would be saying, all right, let's say you have money going in. You have 100K year one going in because you're going to front load 90K plus a 10K premium. Year two, you got 10K. So what's going to happen, the cash value year one, you're probably going to have about 90K available. And let's say a death benefit, you have $1 million. Okay. Now year two, you're going to put in 10K and you're going to probably have 101K total cash value. And you're still going to, you're going to have like $1.01 million, right? Just that's how it would go. And then year three, let's just say this again, you're gonna have like 112K and you're gonna have like 1.12 million, right? That's just 0.012, I guess, 0.012, whatever. Doesn't matter there, it's a rounding error. So if we did this, the challenge is a lot of people say, well, the life insurance guarantees your cash value with the death benefit. And that is true because the reason is if I take a loan against my policy and I die, they know that A, I have the cash value, and B, the death benefit is gonna back it up. So here's the deal though. You're only gonna be able to borrow about 90 to 95% of the money that you see in this cash value column every single year. So when you're going to buy a $400,000 house, you need to have at least probably $430,000, $440,000 of cash value to buy that $400,000 house if you wanted to put it all through your mortgage. Now, I would have said, kind of going back, I don't know if you were here at the beginning of this conversation, but going back a couple of years, I would have told you that conversation would have been totally crazy, but today it actually kind of makes a little bit of sense, right? And this is why I love whole life insurance, because it provides options in different economies, and everybody's used to talking about it just in one way, but now we get to open up that conversation. So here's what I mean. Like mortgage rates. Mortgage rates were, whatever, 3%, we'll just call them. Like they were down 2.75, 2.85, whatever. Let's just say 3% in 2018 through 2021, okay? So that's fine. So now if I could borrow against, let's even say I had $400,000, $440,000 to be able to take a $400,000 loan or whatever, and I could do this. Well, my whole life policy loan rate is going to be, let's call it 5.5% for the sake of argument. And that was in 2018 through present pretty much, because our policy loans haven't really changed that much. They've gone up maybe a quarter percent. So that's all fine and good, but back in 2018 through 2021, why would I go and take a policy loan and pay 5.5% when I could get a mortgage loan from the bank for 3%? The only reason I would use a policy loan here is because if I go get a mortgage rate at 400 whatever thousand, let's say I'm buying a $400,000 house, if I'm buying that $400,000 house, well, now I have to come up with a down payment. And if I pay cash for that down payment of $80,000 down payment, if I pay cash for that down payment, I have opportunity costs and I lose the control of that, right? Because I'm interrupting the compounding opportunity of this 80K, because the value of my house is not going to go up or down in value based on the amount of down payment I put. So therefore, your house is an inefficient place to store money. I've got videos that go through this in great detail. If you want to see it, I got about a half hour video on how to pay off your mortgage, I think is the name of the title. And if you want comment, if you are looking for that video, make a comment in the regular section of the video. Here and in the replay, I'll go back through and I'll link up all the videos and I'll respond to your comment with the links and you could be able to see it all. I just can't do it while I'm doing this. But here's the deal, $80,000 down payment. Back in 2018 through 2021, what I would do is I would take a policy loan from whatever cash value I had and I would self-finance basically this $80,000 down payment, and then I would take the cheap mortgage for everything, right? For everything else, for the balance. But now in 2023, when mortgage rates are higher than policy loan rates, well, if you've got the capital in your whole life policy, well then yeah, absolutely, self-finance away if you want, right? The only challenge now you have to kind of go through the process and say, all right, what is the opportunity cost of giving up control of my money? That is the variable that you have to consider. So when we look at opportunity cost, anytime you pay for something, it's not what you pay, but it's like what your money could earn for you if you had control of it, right? So what I mean for this is like if you have this 400K house, right? And we could get a mortgage at like say 6.5%, and we could get a policy loan at 5.75%. Well, if we could pay for all the 400K with the 5.75%, you see that's saving you, 0.75% on actual interest charges, and that may look good, and that actually there's elements of that are good from a, long-term opportunity cost of money, the interest that we're paying on our house. But you know what happens if you use your policy loan? You've gotten rid of all your protection, all your leverage. This 400K now becomes illiquid, and you have to make payments back to reliquify it. So the question is it worth paying 75 basis points more right here to keep this $400,000 completely liquid to you? So you have it to pay off the house. You have this 400K that you could pay off this mortgage at any point in time if you needed to. So it gives you that flexibility. But if other opportunity presents itself to you, you now have that 400,000 that you could use for another asset. Once again, that's a great, powerful way that you can utilize whole life insurance. And, hopefully that makes sense. But that is something that I think is really, really important to understand about how to use whole life insurance when we're talking about the living benefits for it and, what it can do for people. I think how you purchase your house is going to be one of the biggest financial decisions that you make, and how you navigate it can either provide you with hundreds of thousands of dollars more in retirement or, in your life, or it'll cost you hundreds of thousands of dollars more. It's not just about rate of return. You have to look at all the different variables, and you have to, think about how it fits into the rest of your personal finance. And then you have to weigh, the opportunity cost to all those decisions. And the hard part is that if you don't understand how all this works, it's really hard to make a good decision. It's hard to make an educated decision as to what's best for you. And I don't think it's just as simple as saying run everything through your policy like a lot of people would say. Not that you can't. Thanks, Spencer. Appreciate it, man. So that is what I would say as far as that goes. Now, what else was I going to say? All right, so let's get into this. So the next part about why you would want to utilize whole life insurance, even if you have a whole life insurance policy, I should say, even if you don't feel like you want the death benefit, is for the living benefits through the accelerated benefit riders. Now, I think this is really important. This is something, and I've been making a lot of videos on this lately because this keeps coming up. And I think it's become pretty personal to me. The living benefits, I guess I started doing this when I was 31. And there were something that I never really focused a lot on because I was never really concerned about getting sick or dying or getting cancer or anything of that nature. And then it started to really hit me. I started thinking about the fact that my grandfather died at 63. He had testicular cancer in his late 30s. And I remember seeing that, and it made me think, ooh, maybe there's something to this. Maybe I should think about it. My cousin, who was 20 6 at the time, got testicular cancer. My brother got Crohn's disease. I, thank God, have been super healthy and haven't had any issues, but it definitely got me thinking about the fact that, listen, we're not getting out of this thing alive, and our health is not guaranteed, and tomorrow's not even guaranteed. And so having living benefits, really important. Being able to accelerate the death benefit to pay for alternative medical treatments, I think is really important. This hit really home to me in November of 2020. My father-in-law was diagnosed with stage 4 pancreatic cancer and given 90 days to live. The oncologist said that they weren't going to be able to help him, that the best they could do is probably get him to a year, but his quality of life is going to be really, really just horrible. And we didn't take that answer well. We did not receive it. We dismissed it. And my wife and I kind of dedicated the next month of our life to being obsessed with finding alternative medical treatments and finding the best pancreatic gurus in the world. So I'm not just talking about long-term care benefits, although that is part of it. You can accelerate the death benefit for whatever you want. If you want to pay for long-term care, if you want to pay for alternative medical treatments, if you were diagnosed with a chronic illness or a terminal diagnosis like cancer, you can utilize your death benefit for whatever you want. Heck, you could take it. I had the first check I ever had to kind of deliver was a living benefits check. And the woman took her family. She didn't want to deal with the treatments. She didn't want to deal with all the dealing with the hospitals and medical stuff. She was also ironically diagnosed with pancreatic cancer. She just wanted to take her 8 family members on a trip around the world. So she got a $400,000 some odd check and took her whole family on the trip of a lifetime. And she enjoyed her last healthy 6 weeks with her family. You can utilize the money for whatever you want when you get that living benefit. My father-in-law, he chose to fight. He chose to invest in multiple 6 figures of alternative treatment. And even though he was given, 90 days to live at that time, he's alive now, almost 2 years later, and he's literally playing golf 4 times a week still. He's still got his 7-centimeter tumor on his pancreas and on his liver, but the doctors now consider him a miracle because we've controlled the growth of the tumor. And they basically said that he's probably going to die with the tumor, but he's not going to die because of it. And, the problem with most, and I'm sorry, I'm on my soapbox here about this stuff, but this is why I'm so passionate about this, is when you look at the traditional medical world, I get it. It works for some people. I'm not saying it's all bad. It's just not right for me. And there are certain situations where certain traditional treatments do make sense. And I'm not going to argue with people about that. But I know too many people that have had too much success with alternative treatments. And I believe our bodies are really powerful beings. And they're just amazing at self-healing if we give them the environment to heal in. I could just say for my father-in-law, pancreatic cancer is basically a death sentence for most people. And I think we've proven with him, hey, we've been able to control this tumor. He's never going to get rid of it. But if we can control the growth of it and we can keep it at bay, he's not in any pain. His quality of life is not down. And the fact that he's going to be able to live and play golf and enjoy the rest of his life and spend time with his 3 grandkids. My wife and I have 3 kids, so it's like spend time with the 3 kids and live right down the street from us now and be able to enjoy that. To me, that's massively powerful, and that wouldn't have been possible had he not had access to the capital to be able to pay for that treatment. These are treatments that insurance doesn't cover. So we have to self-insure for that. Now, kind of coming back to this on the living benefits thing, one of the things that I think is really important to understand as we look at this is that when you're in retirement, right? So if we talk about retirement, there's a thing is medical bills are the number one cause of failed retirement plans because you got to chew through, your retirement funds to pay for medical bills, failed retirement plans, and bankruptcy. Okay, so this is a problem. If you get to retirement and you don't have the right long-term care insurance, you don't have the right insurances, and by the way, it gives you control of your medical directive. Like, think about that, because like the last thing that I want, if I get diagnosed with cancer when I'm in retirement or something of that nature, the last thing I want is to not be able to treat that cancer the way that I want to treat it, that I have to just fall in line with what the insurance company tells me. I think that's one of the big problems that we have, is people are not taking enough accountability and building their own finances in a way that puts them in the driver's seat for the results in their own life. Like, this is the same reason. I think this is the number one reason every single person should have whole life insurance, is right here. Because Dave Ramsey, okay, I'm going on a rant here. Dave Ramsey always says, oh, you don't need whole life insurance. It's the worst product in the financial industry because you could just self-insure beyond that. You only need term insurance for a certain period of time. And once you can self-insure, you can get rid of the term insurance and you're good to go. You don't need that insurance once your kids are gone, once you have all your debt paid off and blah, 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 blah. Well, I got news for you. When you get to retirement, our health becomes uncertain. Whole life insurance is about more than the death benefit. It's about more than the cash value. It's about the fact that you have these living benefits. If you become critically, chronically, or terminally ill, you have access to the death benefit while you're alive. Different portions, different amounts, whatever, but you get to utilize that money how you see fit. Do you want to find alternative medical treatment? Do you want to just be able to pay for your copays on your insurance because you believe in traditional treatment, but maybe your insurance only covers a certain amount. You got to come out of pocket for the other stuff and you don't have the money to do it. This is going to do it for you, right? Like, it puts you in control of all of this. So it insulates, it protects your other assets. Now, should your whole life insurance policy be the only asset that you're relying on? Heck no. No way, no how. That's another issue I have, is with people being like, you should put all your money into a whole life policy. If you think you're going to get there just putting your money into a whole life policy, I got another thing coming for you. Now, do I believe in the stock market? No. Do I think the stock market's good for some people? Yes. It's not for me. I love real estate. I do believe in putting money into a whole life policy, leveraging that money for real estate. I take my risk in the real estate, not the life insurance. That's one of the reasons I don't like index universal life, because I don't want to take risk inside of my life insurance contract. That's not what life insurance companies do well. So I want to use them for what they do well, which is giving me the best rate of return with the least amount of risk possible, and let them manage it. And that is what a participating mutually held whole life contract does, not an index universal life policy. I would say, Menzer, you say diversification is key. I would say there's different ways to diversify. A lot of people look at asset classes as diversification. I could say I could diversify in real estate. I could do multifamily, single family. I could do international. I could diversify regionally based on location. All these different things. Elaborate, how are advanced death benefits work logistically? Yeah, so if you just got to get a letter from the doctor. Like, if you hit any of the qualifications on chronic illness, you lose 2 of 6 daily living activities, or you become cognitively impaired. That is a chronic illness for most companies. Terminal illness typically is 12 or 24 months of life expectancy based on a diagnosis. If that diagnosis went untreated, that is a terminal illness. And so if you get diagnosed with any of these things, then you go to your doctor, they write a letter, you submit that to the insurance company. You then have to work with your agent in the company on having a portion of your death benefit advanced. They basically accelerate the payment of your death benefit. It goes to you, you utilize that treatment. Now, you utilize that money for whatever you want. Like I said, I had a client just take a vacation with her family and give up on healing because she didn't want to, and she's a little older and it was what it was. That's fine. And then I've had my father-in-law who's fought and is winning the battle. We've had other people do other things. I think, to me, it's about flexibility and control, and it's just about the confidence that you have it there to be able to do it. There's different ways that you can take the money. You could take installation payments of that death benefit. That gets you a little more over a long period of time, because obviously the time value money works into everything. And then you could take a lump sum payment. It's kind of like when you win the lottery, right? Like, you could take smaller payments over a period of time, or you could take which add up to more money, or you could take a lump sum, which is a smaller money, but you get to control it all at once. And so you have to decide what's best for you. At the end of the day, that's really what it comes down to. So there's that. that's the logistics of how it works. But I think the power of the living benefit and how you can handle your medical directive, how you can kind of have control over how you treat yourself and how you protect yourself against medical bills in retirement, I think is really powerful. But the other thing that I think is really powerful on this is utilizing whole life insurance as a volatility buffer, because this is what I say, you shouldn't ever have it be the only thing that you rely on. But if you have, if we look at a volatility buffer strategy, what we're talking about is the fact that let's say we have $1 million invested in stocks, okay? And let's say we're using the 4% rule, okay? So what the 4% rule is, and this is above and beyond any pensions, any Social Security, anything that you're doing. We're just going to talk about this hypothetically. So 4% rule says you could take $40,000 of income per year out of this $1 million without running a significant risk of running out of money. This is kind of the general rule of thought that all financial planners utilize as a foundation of kind of safe distribution of capital, of investment capital, right? And so that's kind of what they do. That's where they start. So when we look at it from that perspective, okay, the 4% rule is what it is. Now what happens is we have this little thing called sequence of returns. Because when we retire at 65, let's say, at 65 years old, we don't know when the market's going to be up or down, right? We have no idea how the market's, is it going to go up, or are we going to be entering retirement in a down cycle? Think about it. If you retired in 2009, that was a bad year to retire, because you just got, if you retired with $1 million, all of a sudden the next year that $600,000, was instantaneously, or the $1 million instantaneously became 600,000 because you lost about 40% of your portfolio year one of your retirement. The rest of your life looks pretty bad, right? Because if you were relying solely on that, it's really bad. Now where whole life comes in is no matter what, because we know the market's going to be up, it's going to be down, it's going to be like this. And over a 40-year time frame, which I believe is 30 to 40 years is what you have to plan for, you're going to have 3 to 4 boom bust cycles. That's just the way it is, where it goes up, then it comes down. It goes up, it comes down. And we know we're going to have these happen. And the reality is 25% of the years are going to be down markets. That's just historically speaking, 25% of the time you're going to lose money in your account. So if you're, and when I say lose money, I mean it's going to be lower than the 4% you're taking, lower than the 4% you need. So what we need to do is we need to prepare and think about how we're going to be distributing during these times. And where whole life comes in really powerfully is on the negative years, the 25%, you're going to use your whole life insurance for income to allow your other assets, your other stocks. So you don't have to take money out here. You use your guaranteed asset in whole life. So this goes back up, right? So this is, and when you utilize whole life insurance as part of a bigger plan, part of a greater strategy, as an asset in a portfolio, whether it's real estate, stocks, or other investments, whole life, I always say whole life insurance is like the BASF. Remember BASF from the 90s? It was like, they did commercials on the NFL all the time. It's like, at BASF, we don't make the products you buy. We make the products you buy better. It's like, we don't make your fishing line. We make it stronger. We don't make the paint you use. We make it brighter. All these different things. So whole life insurance is just the BASF of the financial industry. It's not like super sexy. It doesn't get all this like attention and hoopla because it's wildly misunderstood because of people like Dave Ramsey. But when you look at the power that it can bring to the table and how just having it in place as part of a bigger plan, it actually increases and elevates the performance of your other assets when you do it properly. And that's what the strategy is all about. What is the lowest amount I can finance a whole life insurance policy per year? I would say that's, if you're asking that question, and I don't mean this at you personally, but if anybody's asking what's the lowest I could do, it's a misunderstanding. So here, let me say this. Life insurance companies. So the government is actually who sets government, if I could spell right. The government sets the rules on how you can fund your life insurance policies. So there's a minimum. I'll do this. There's a minimum. So there's a minimum, which would get you just the death benefit. But then there's a maximum cash value, meaning how much you can fund that policy for, that goes in here to avoid MEC, to keep it below the MEC limit. So what the government says is like, you have a death benefit. Let's say you have a $500,000 death benefit. Okay? The government's gonna say, well, the life insurance company is gonna say, well, this is the minimum that life insurance is gonna cost you. So you could pay the minimum and get the 500,000, in which case the cash value accumulation is gonna take a long time and it's not gonna be very efficient. However, we could then look at the government and say, what's the maximum that I'm allowed to contribute for this? What's gonna happen is everything above the minimum and the maximum that the government is gonna allow me to do is gonna be more cash efficient. So what we do is a modified endowment. This MEC stands for Modified Endowment. Told you. Contract. Okay, so that's a MEC. We call, if you fund up to the maximum you could do, and if you hit this modified endowment contract, they give you within $1 of what you're able to do. Let's say the minimum a life insurance company says you could pay for $500,000 would be like $5,000 per year. That would be the minimum. And hypothetically speaking, let's say the government says you could put up to $40,000 per year in that contract. So if we pay $40,001, I should say, what that becomes is a MEC. And when we make it a MEC, you lose all the tax benefits. And so you obviously don't want that. So what we do is we call it a maximum efficient contract. And a maximum efficient contract is when we fund it right up to the dollar that the government allows us to do. So we don't focus on this when we design policies for people. That's the last thing we focus on. What we do is we say, all right, what is your number? What is the amount that you have to spend, right? What is your number? Is it 5,000? Is it 50,000? And even though some people watching this might not believe it, we have some people that come to us with 500,000 a year that they want to pay in premium. Now, obviously, it gets a little more complicated. There's a lot more financial auditing that goes in for the insurance company to make sure you can afford this. It's a completely different level, but it happens all the time. But regardless, it's a different animal. We're not trying to solve based on what's the death benefit we're going after. We're trying to figure out, based on 5,000, how do we make this become, actually the maximum efficient contract and fund it right up to the amount, right, that the government will allow us to. And so that's how we reverse engineer it. And then there's other ways you can front load policies with bigger, like 50,000 up front with like 5,000 a year ongoing. There's different ways that you can fund this and create flexibility, to do so. But I would say don't think about the minimum that you can pay. The minimum is based on you. I would say a rule of thumb, a lot of people throw out there that the rule of thumb for minimum is like 10x your age. That would be the minimum monthly payment. So if you're 40 years old, equals $400 per month. I would argue, I don't like that line of thinking. I don't like that methodology of figuring out, the premium payments. I'm not saying it's wrong. In fact, it's better than nothing. But I would say the best thing to do is to understand you can't draw blood from a rock, right? So how to figure out what's the minimum? I would figure out what are your goals, right? I would say the goals on your minimum should be figuring out your emergency and opportunity fund. Right? So if we look at these emergency and opportunity funds, the question is how much do you need? If you have $50,000 and you want to have $25,000 in $25,000 in emergency fund, right? Well, what's your time frame on doing that, and how much per month are you going to have to do to get there in the next 2 years, 3 years, like depending on what your goals are, and then you can reverse engineer how much you need to fund it. And same with an opportunity, you just add to this based on the opportunity fund, and you figure out how it all plays into your personal finances. I think if we just make this blanket statement that $400 per month because you're 40 years old is the minimum you can do, that's not really catering a policy to fit your goals, your designs, your objectives, your goals, your desires, like what you want to accomplish in life, what you want to set up for the next generation, and all these different things. It's not really thinking about the long-term plan, how this plays in with other assets to fit the need to become a volatility buffer. It's not thinking about, the other thing I think is really important. I want to add this, because a lot of people are online saying that the policy design, they like the 1090 policy design where it's 10% PU or 10% base, 90% PUAs. And people say that this is the way to go. Now, sometimes I like this, because it's got more cash value year one. Year one is higher on the cash value side. But the problem is when we start talking about the living benefits as we get older and the long-term growth, like I said, there's no free lunches in this. The lower the base on this, the worse these are going to be. So when you say, when you take a look and you say, all right, well, this is the best way to design a policy. A lot of people say that, and a lot of people will say, no, 40-60 is the way to do it because that's what Nelson Nash says to do. No, neither one is right. The right policy is the one that's designed taking all of your thoughts and concerns and goals and aspirations into consideration. And my phones are blowing up right now, so I don't know what's going on. People want to talk, I guess. So that's what I would say there is really understanding all of the moving parts, what your goals, what your aspirations are. If you're an agent, what I would really, really encourage you to do is think about learning how to ask the right questions to get to know your clients so you can serve them the best, because I truly believe that a whole life insurance policy fits into every single person's financial world in some way, shape, or form at some point in time. It may not be the right time right now, especially if there's a lot of debt and they're leveraged out and it doesn't make sense and the cash flow isn't right. And if that's the case, I would get a convertible term policy. I would lock in the insurance need, which if they have a lot of debt and they don't have enough cash flow, there absolutely is a need for convertible term insurance to have that debt covered. That way it doesn't be left to people when they pass on. And so, I would say that absolutely is a need. And then once you have that dialed in, and you pay off debt, then you can go with a whole life insurance, right? Like that's the deal. Then you could start focusing on your emergency fund. You can start focusing on your opportunity fund. You can start worrying about financial efficiency. But the first part about it, make no mistake about it, for financial efficiency is to eliminate toxic debt, eliminate consumer debt, eliminate all debt that is holding you back ultimately, which is most debt, right? Like, and actually, let me talk about that real quick, and then I'm going to probably bounce. But debt is simply assets minus liabilities, right? Because that's net worth, right? Assets minus liabilities is net worth. So let's talk about this. And let's use the home example that I was talking about before, because I think it's really relevant for this conversation. So let's say you have a $400,000 house and you want to finance all of it. And people are saying, well, I have my $400,000 sitting in my whole life policy, or I have cash. What should I do? Should I pay cash for the house? That's what Dave Ramsey would say to do. Pay cash for your house. So what do I do with this? Well, my mindset is I'm going to finance this home. Why? Because if I can get it at like 5% or whatever the rate is, I'm going to finance it. I'm going to mortgage it because I want to keep control of that $400,000, because I know on that $400,000 I can earn more than this 5%, right? So the goal is I have this $400,000 sitting on the sideline. Why? because it's not really a debt. I have a mortgage, but that mortgage is just leverage. But if I have this $400,000 sitting on the sideline, it's not really debt. I could pay it off at any point in time. So why not keep control of this money for flexibility and control? The only reason you would pay cash for this, and this is who Dave Ramsey talks to, is if you don't think you're bright enough or disciplined enough to be able to handle this $400K with responsibility. And that's what Dave Ramsey's, I believe, why Dave Ramsey says what he says and why he believes what he believes. He thinks you're too stupid to manage this $400K properly. And I just choose to say, I'm gonna have more confidence in you to learn this stuff, more faith in you to act in your own best interest, right? To be able to do this, to be more financially efficient and accomplish your goals more predictably, right? Like, I'm not saying it's easy. I'm not saying you're not gonna have to grow and learn about this stuff, because you are, but like, I got news for you. Like, if you don't learn how to do this stuff, you're never gonna win the game anyway, no matter what you follow, from somebody like Dave Ramsey or Susie Orman or any of that nature. So, that's what I would say. So, all right. So I've been going a long time now. It's been a good little time, fun little rant. Hopefully, does this make sense to everybody? Because like this is, this is one of those conversations that comes up all the time about people. I just fully believe everybody should have whole life insurance policy. If you are in the place where you can, like I just described, maybe you're a little premature because you got debt and stuff, you got to clean that up. If that's the case, reach out to us. I pinned a link at the top. You could set up a clarity call with somebody on the team. That clarity call will have a conversation about like, what is it the right time for you? How do you design the policy for yourself? Should you just get a convertible term policy in the meantime while you clean up your other debt, but lock in your insurability, lock in the coverage, make sure you're good to go, make sure your family and business partners and all those people are taken care of. Make sure they're protected against your demise if that happens tragically, and kind of go from there. Because this is after that, I just believe everybody needs an emergency fund. Everybody should have an opportunity fund. Everybody's going to want to have a volatility buffer in retirement because it's just going to make all your other investments better. And everybody should have control of their medical directive in retirement. So I think when you look at it through that lens and with those perspectives and with those objectives in mind, to have an asset solve the needs for you, I think I know no other asset will provide for you those benefits and those attributes. And I think if we get rid of the name whole life insurance and we just look at, all right, as I go through life, what do I need my money to do for me? What are the risks that I'm going to have? What are the challenges that I'm going to face? And what are the different assets I'm going to need to store my money in and invest my money in to be able to protect myself and provide for those needs as I go through life? And I think no other asset is going to check off more of those boxes than whole life insurance. And that's why we say utilizing a whole life insurance policy is getting each dollar to perform multiple functions, which I think is when we talk about financial efficiency, that is a huge, huge deal. And you need to understand it and you need to be disciplined and think about how this executes in your life. And if you have any questions about that, it's one of the reasons we walk everybody through a Life 180 X-ray. We can walk through and we can help you get clarity. Once again, clarity call on what this looks like in your life. And if you are an agent and you're looking to learn this stuff more, I'm not sure if you're with somebody right now, but we are also looking for the right agents to join the team, for some of the best training. We're really expanding and making a big push right now because I've been getting so many calls, so many emails from people that are just trying to learn this through other organizations that don't understand it. And we're really being focused on building the best agents in the industry. That's really my mission for 2023, especially as we end this year, is to really build the best agents in the industry and kind of go from there. So anyway, hopefully that helps, guys. Hopefully you found value in this. I have a lot of fun doing these lives. I appreciate the engagement, and I'm looking at some of the comments here. I have a lot of fun doing this, and thank you so much for the engagement today. Once again, go back through. If you are interested in connecting with us on any level, just go to the Clarity Call link and you can check it out there. I will actually, if it's not there, I'm not sure how this shows up on the YouTube chat here, but I'll just, there we go. So we'll do that. If you want to go there, check it out, feel free. And that's it. Have a blessed, inspirational day, guys. Take care. See ya.